morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at the financial results of two locally listed Canadian banking giants. Of course, we're speaking about Scotia, Trinidad and Tobago, as well as CIBC Caribbean. Now, both groups would have reported contrasting fortunes for their 9-month fiscal periods ended July 2025, respectively. Let's take a look at what would have occurred and what investors might expect in the coming months ahead. Turning firstly to Scotia, Trinidad and Tobago, or Scotiabank, or SBTT rather, the group would have reported an earnings per share figure of just over $3 for its 9-month fiscal period, as mentioned, of 2025, an 8.7% increase from the $2.77 recorded in that comparable period of 2024. Now, net interest income would have driven that improvement in results, up 8.8% from just over $1.06 billion to $1.15 billion. Total revenues coming in at about $1.56 billion. Overall, an 8.3% increase from that $1.44 billion recorded in the prior comparable period. Now, when we take a look at non-interest expenses, we can see that there was a 4.2% increase from $620 to $646 million. Overall, profit attributable to equity holders for that 9-month period, increasing that 8.7% from $488.4 million to just about $531 million. Now, when we take a look at the revenue growth attribution, we can see that, again, net interest income in that yellowish column, up that 8.8%, as well as other income increasing just about 7% from 382 to just about 410 odd million over the comparable period. So certainly positive revenue trends for Scotiabank, and of course that would come as good news for investors and shareholders at this particular point in time. Operating efficiency also improved. A lower number is better in this particular ratio, and we can see that that operating efficiency ratio fell from 43% to 41.4%. What does that mean? That means that expenses aren't growing as fast, or non-interest expenses rather, aren't growing as quickly as revenues overall. And we can see that over the comparable periods, non-interest expenses would have grown from just about $620 million to about $645.7 million. Again, that 4.2% growth. Compare that to total revenue growth of 8.3%, and you can understand why that efficiency ratio would have improved, falling from that 43 to 41.4%. Now, some changes in Scotia's total asset combination or allocation. We can see that total loans would have grown just under 2% from $20.5 billion to $20.9 billion over those comparable points in time of 9 months, July 2025 versus July 2024. A major change in terms of overall investments, with roughly a 25% increase in this particular asset segment, from $5.9 billion in that greenish color to $7.4 billion. Again, that 25% odd increase, whereas other assets would have declined. So some reallocation into more interest-generating or higher return-generating asset allocations, and that would have been seen or been evident in terms of total revenues generated. So currently, in terms of banking sector valuation, Scotia is again at that higher end of the banking sector valuation of 12.2 times price to earnings ratio, compared to that sector average of 9.4 times at its current price of $48.50. But it does offer investors quite a juicy dividend yield of 5.8%. Scotia has historically been one of those very reliable, very consistent dividend stocks, and that is compared favorably to an already very attractive banking sector average dividend yield of about 5%. So with that strong revenue growth in mind, those attractive dividends, and keeping an eye on that elevated valuation, again, relative to the sector, Bourse is maintaining its market weight rating on Scotia for the time being with a stable outlook. Turning quickly to CIBC Caribbean, well, the group would have reported an earnings per share figure for that 9-month ended July 2025 period of 47 cents per share, a 48% decline from this 90 cents per share recorded in the prior comparable period of 2024. Now, driving that performance was actually a decline in total revenue of 7.4% from $3.7 billion to just about $3.46 billion. TT equivalent operating expenses increased 7.3% from 2.2 or TT billion equivalent to 2.33 TT equivalent billion. There was a significant increase in credit expenses or losses on financial assets from 17.9 to 234 million, attributable to a particular one-off cost that would have been incurred during the fiscal period, and ultimately that would have led to net income attributable to equity holders falling from 1.42 billion to just about 740 million TT equivalent over the comparable period. When we take a look at revenue composition for CIBC, we can see that net interest income was actually up just about 0.5%, despite lowering U.S. interest rates, which the company or the group would have given guidance over prior quarters that it would impact overall revenue generation as U.S. interest rates would have come down, and hopefully that would have been offset or will continue to be offset by volume growth. Total operating income, however, fell off just about 27% from 1.06 billion to 767 million on TT equivalent, leading to that 7.4% decline in revenue. When we take a look at profit before tax by segment for CIBC, some fairly notable changes. Corporate and investment banking in that purplish column down just about 31% from 1.25 billion to 855 million TT equivalent. Partially offsetting this significant change was an increase in retail business and international banking in that bluish column by about 145% increase from 151 to 371 million TT, or the equivalent. Wealth management actually swinging from a profit of 52 million TT equivalent to a loss of 333 million or thereabouts, no doubt perhaps associated to that one-off loss related to some financial assets that would have been included in the current fiscal period. Now, when we look at valuations, again, for CIBC, that significant decrease in 9-month earnings for this period would have led to increase in the price-earnings ratio, traditionally between just around 8 times or thereabouts to 11.5 times, above that sector average of 9.4 times once again. With that lower revenue in mind at this current $8.25 price per share, those high operating expenses, but of course keeping an eye on, of course, very attractive US dollar dividend payments, particularly in the current environment where foreign exchange can be an issue for investors. CIBC offers a dividend yield of 4.1% in terms of its trailing dividend yield compared to the sector average of 5%. And on that basis, Bourse is maintaining its market weight rating on CIBC for the time being with a stable outlook, given that it's one-off expenses not expected to reoccur in subsequent periods. So that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse. Email us at info@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article on today's business or in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, and we'll see you again on the Bourse Report.